Few people alive better understand how Capitol Hill and Wall Street work than former Congressman and financier David Stockman. And he is deeply concerned that our current political, monetary, and fiscal policies are setting the stage for an epic breakdown in the economy as well as the financial markets.
It's way too dangerous. This situation has now gotten to the point where something's going to give. And when it gives, it's going to be big. It will be violent. I mean, the Dow could go down thousands of points in a very few days if the unraveling starts, and then there'll be no place to hide.
Hello and welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back to another week of making sense of money and the markets. And right before we get started with today's excellent interview with David Stockman, I just want to remind folks, if you have not yet already, this Wealthion YouTube channel is brand new. And every new subscriber helps us in terms of getting discovered on YouTube. So if you can take just a quick second and click that subscribe button below, along with a little bell icon next to it, and that way you'll never miss another one of these videos going forward. All right, and now on to today's guest. Whenever David comes on, I have to give his long background because he's just done so much in his life, but I will try to be as quick and concise as possible as I can about it this time. David served in the U.S. House of Representatives. He also served as the director for the Office of Management and Budget under President Ronald Reagan, making him the youngest serving cabinet member of the 20th century. He then went on to a storied career on Wall Street, where he worked for the Blackstone Group, Salomon Brothers, and other major financial institutions. David also during that time served as a member on the Council of Foreign Relations and a bunch of other amazing lists. The reason why I give all this backstory is just to hit home that there are few people who have an insider's perspective to both Capitol Hill and Wall Street alive today more than David Stockman. David, thank you so much for joining us today.
Okay, thank you, Adam. And next time, the short version is I spent 40 years in Washington and on Wall Street, and so therefore I've never had an honest job.
All right, well, I'll let you say that. All right, David, look, as we kick things off here, I want to treat you the same way I treat all our guests. I want to ask a question before I introduce any potential biases of mine. What is your assessment of the current status of today's economy and financial markets?
Well, I think we're in uncharted waters, and not just a little bit or even a lot. I think we're in from another planet uncharted waters. We have never seen anything like the explosion of central bank balance sheets or the explosion of government budgets and deficits, not just in the United States, but everywhere, that we've seen in the last 12 to 15 months. Two or three statistics, I think, make it pretty clear. If you take total government spending in the United States during the last year, it rose by $2 trillion, federal, state, and local combined. Now, the reason that I mention that is not because it's a big number, but because it's nearly 5 times more than the increase during the bottom of the Great Recession, in 2008 and 2009, where we thought the world was ending. So they've never tried anything like this before. That's the first point. The second point is it was all basically monetized and accommodated by the Fed and other central banks. Now, again, if you go back to, people remember, September 2019, when we had the little repo ruckus and the Fed reversed course and started expanding its balance sheet again. It was 3.8 trillion then, it's 7.8 trillion today. That's 4 trillion of balance sheet expansion in 15 months. And the reason I mention that is that in the first 100 years of the Fed's existence, from 1913 to 2013, it took that long to get the first 4 trillion that we've done in the last 15 months. So the reason these things are important is not because they're big, scary numbers, but because they represent interventions in the financial marketplace and in the economy that are so big, so extreme, and so consequential that things are going to be happening that we've never seen before. Let me just give one and then we can move on. if you look at where the GDP was in the fourth quarter of 2019, call that the pre-COVID benchmark. Now, at the time, according to Donald Trump, that was the greatest economy in history. Whether that's true or not, we can debate. I doubt it. But the point was, the economy was doing pretty well, and people thought prosperity had reached a pretty high level. If we use that as a benchmark and calculate what has happened since, we've lost about 800 billion of GDP. That's a lot, but it may not be quite as big as people would think after we went through all the traumas and dislocations of last year. Why is this important? Because let's call it an 800 billion hole in the GDP or the economy that generated a 6 trillion response in terms of the 5 different so-called COVID relief or bailout bills. So, they are so out of control, off the deep end in Washington, and it's been made so easy to borrow money and spend money and, shower the economy with free stuff by the Fed that they've actually filled the hole in GDP about 5 times over. And that's just, one little statistic, of how far off the beaten track we are. Now, the key question, I think, for everybody going forward is this can't go on indefinitely. Even the politicians down there recognize that. So what happens the morning after? What happens when spending, which got ballooned by this 2 trillion, or 7 trillion at the federal level alone, has to retract back to something that's quasi-normal? What happens when the Fed finally stops buying, and it will have to sooner or later, the 150 billion or 120 billion a month of new treasury securities that it's absorbing? Well, I think there's going to be a hell of a day of reckoning. The economy is not prepared for this. No one knows how to anticipate it or calculate the consequences because it's never been tried before. But it does violate every rule that we've learned in hundreds of years of sound money, of stable finance, of rational economics. It's all been thrown overboard. And so I think we're going to face some pretty interesting times, as they say.
Okay. Well, that is a very clear picture, I think, of what you think about what's gone on. I do want to ask you to lean into the repercussion side of things here. So you've said uncharted territory. They have taken measures that are completely historically unprecedented. And, you did that great comparison of the $800 billion GDP hole, but the 6 trillion in stimulus. So just overwhelming liquidity and stimulus. But you say this can't go on forever. It has deformed the system. And you wrote a wonderful book called The Great Deformation, which I'm going to ask you about again a little bit later. But we have this massively distorted, deformed system that you say is eventually going to have to historically contract or correct at some point. What does that look like? What could that look like based upon your best assessment, both from an economic standpoint and a market standpoint? Market standpoint, I bet it means we're going to see a lot lower prices. I'd love to get you to sort of get a sense for how low they could go. But economically, what does that mean?
Well, I think it means that the boom that the market seems to be anticipating and discounting is illusionary in the sense it's not permanent. There will be a boom. I mean, when you pump this much money, free stuff, as I call it, from the fiscal side, or easy money from the central bank side, in the short run, there's a hell of a lot of build-up liquidity and savings, if you want to call it that. It's not really savings. It was just money, borrowed by the Treasury that was then printed by the Fed and handed out to people, and they couldn't spend it fast enough. So it's there in the cash accounts and the checking accounts of the country. But the point is, that's a one-time thing. And we may have a couple of quarters of, these high numbers. They'll say the biggest GDP expansion, or let's say PCE expansion since 1984, 1985. but then it'll be here and gone. This isn't sustainable. This isn't permanent. This is truly, like some watermelon going through a boa constrictor. And, the market is not looking at what's on the other side when supposedly the job of the financial markets is to discount the indefinite future, not next month, next quarter, or even next year, but the permanent outlook through some kind of discount rate and therefore a PE multiple. None of that's happening. There is this huge assumption that we're going to have a boom and it's going to stay a boom, when history tells us that this kind of artificial boom is going to lead to a big time bust in consumer spending. And if consumer spending takes a dive, it's going to panic the hell out of the financial markets, because they've been expecting smooth sailing, from time into time immemorial. And when all of those expectations are disappointed or refuted by the so-called incoming data, I think there's going to be a real day of reckoning in the casino. People are going to be lost. There will be panic. And these levels in the market are so artificial. They have been pumped so high that there will be nothing down below. For instance, all the shorts are dead. They've been killed over the course of this massive increase in the market. I was writing about one today, and I think people might be generally aware of this. But if you track back 1 year ago, when the whole COVID lockdown thing was just getting started and people were in panic mode, but the market had already recovered. I'm talking about April 21st, 2020. The Russell 2000 is up 85% since April, since a year ago. And you could say, well, that's because it was deep in the cellar because of the initial panic in March when everything shut down. Well, the truth is, if you go back to January 2020, before COVID was even a thing, before anybody heard of it, the Russell 2000 is up by 35%. Now, those are the mid-sized and small companies in the U.S. economy. They're more dependent on maintaining this economic free stuff bubble than even the the big cap S&P companies that maybe could find a better spot to generate income and profits around the world. But here, how can you possibly justify this? And yet, this is the kind of mentality we have in the market today, which, is kind of a drastic recency bias. There's no longer any worry about the future. There's no longer really any economic analysis in the market anymore. It's the Fed will take care of us. The central banks will come to the rescue. Interest rates will stay at rock bottom forever. There's nothing that can change this awesome picture. So buy the dips, and move on to the next phase of things. I just think that's wrong. It's dangerous. And there's going to be some, real trouble that eventually comes down the road.
All right, so I think to the rational, reality-based viewers watching this, there's probably a lot of heads nodding as you're saying that. Yeah. But if you can, poke the hole in the narrative of the person that says, look, the Fed and now Congress, have decided that they're not going to let this drop under their watch. And yeah, maybe we have a quarter or two of sugar highs. But if we start coming off them and things get rocky, they're just going to print even more. So what is going to end that cycle to bring about this, economic contraction that you're worried about?
Well, I think sooner or later, the bluff will be called on the central banks of the world. And what they're doing, right?
By the bond market with rising rates that are out of their control, or how? How will the bluff be called, do you think?
The bluff will be called if the central bankers are unwilling. If you take all the big central banks in the world today, they're buying monthly nearly $500 billion worth of paper. mainly government debt, but quasi-government debt and GSE and so forth. I'm talking about 120, 150 billion here, 150 billion in the EC. China is doing a heck of a lot, Japan, and so forth. Now, if you could convince me that they're just going to do that with impunity as far as the eye can see into the indefinite future, the entire decade of the 20s, then I would say, go out, drink, eat, drink, and be merry and buy all the stock you can find. But I just think, rationality, economic fundamentals, financial history tells you that can't happen. And that one of these days, the central banks are going to lose it, because even the central bankers will start to disagree with them among themselves about how far they can go or how long they can do this or how they explain it to the market. But once they allow panic to set in, it probably wouldn't take a lot. Because remember, the bigger these bubbles expand and the higher these indices rise nothing that's really sustainable or fundamental, the easier it is to have a huge, violent downdraft that the central banks won't be able to stop, in my view. Now, that could be wrong, but if it is, it means we should all stop working. We should all stop saving. We should all stop figuring out, how to produce more for less. Just wait for the central banks to print the money, the governments to borrow it, drop it out of helicopters, send us our stimmy checks every month, and be on with it. But this can't work. It can't work. And if it does, mankind is missed the boat, for many centuries now. If we'd only known that you didn't have to work and central banks could print prosperity. I just don't believe that.
Right. I mean, I think from Roman times with the coin clipping and whatnot, we've learned that doesn't work. Sadly, I think there are a lot of people right now who are not working and staying home and collecting the stimulus checks and then speculating them into the markets. And
well, that's what the whole Reddit, the whole Reddit mob is about. That's what, frankly, all of the crypto crazies. I'm not totally against cryptocurrencies. In fact, any currency that's not a state issued currency, I would be for in principle. But what's happened in this speculative market is that anything that can be traded ends up in the hands of speculators and it gets pushed to extremes. I mean, look at Bitcoin. I mean, what is it up, 6 or 8x in the last year? What does that have to do with anything that's remotely related to an alternative sound money that could displace the fiat currencies that exist in the world today? Or, last week we had Coinbase going public at a market cap for a few minutes there. That was 100 billion, double the market cap of the NASDAQ, which has all the high-flying stocks in the world on it. Just think about those things, or what's going on in the NFT space right now. My favorite one, because these are all the gambles going on. In other words, the world is just being absorbed, consumed in speculation and gambling. And that's usually what happens when you get near the end of one of these great bubbles. But we had NFT sold the other day, which was one dot, for $1 million.
The pixel, yeah.
One pixel. It's called the pixel, and it sold for $1 million. Okay, so but you could laugh at these things, and then I hear these people come on Bubble Vision say, "Oh well, this is the kids playing on the sidelines of the big game." But that's not happening down in the heart of Wall Street where the adults live, and real financial price discovery and so forth is going on. Well, that's baloney. I mean, the whole system is gambling, and out on the edges you have the real crazy stuff. But it's not that much, far removed to look at things. The other day, I was looking at, the big deal of 2 days ago, I guess it was, or yesterday, was Kansas City Southern has been this the object of bidding war between the two Canadian railroads. So I looked at what the price at $325 a share looked like. And basically, it was 48 times LTM net income and about 36 times LTM EBITDA less CapEx. This is a railroad. You look at that railroad, it's grown about 2% a year for the last decade. So, so when you get all the way to the other side of the playing field, from the high tech and from the fangs and then out into the extreme speculative arenas, and you look at railroads, which are about as plodding and solid as you can get, being valued in a takeover at 48 times. Now, of course, they said, well, there's some synergies. Well, you look at the synergies, and to even begin to remotely justify the price, the synergies would have to be more than the total sales of the Kansas City Southern. That's nuts. Why did it happen? Because the two bidders can borrow $20 billion for almost nothing. And so therefore, almost any deal is accretive when the capital cost of the acquisition is practically nothing. And second, the two bidders have stocks that are valued at 30 or 40 times net income. So, they can issue a lot of that bloated stock and then move along. Now, why is this important? Because it's happening all over the financial system, and it results in what we, have always called malinvestment. Distortions, misallocation of capital. And an economy can't grow when all kinds of stuff is being encouraged, like startups that have no hope of ever getting anywhere, raising hundreds of millions of capital, which they burn and eventually die, or massive amounts of borrowings being used to buy back stock and all of the other financial engineering maneuvers, or to fund big M&A deals that make no sense and have to be unwound a couple years down the road in the course of events. So all of these things are happening, and at the end of the day, the debt and the malinvestment is a increasing drag on the ability of the economy to grow, even as the stock market is essentially capitalizing growth and earnings that are growing at historically unprecedented rates. Well, in my view, the two things can't happen. So that's one of the consequences, and an economy and financial system increasingly encumbered with debt, malinvestment, and misallocation of capital.
All right, and I think that accretion of all that malinvestment too, you think of it as a growing anchor or drag on the economy, as you're saying. But I live out here in California, and we've got fire season coming up. I think of it as also just like the detritus that builds up, on the forest floor when it's not being well managed, and that's the stuff that becomes the conflagration, when that spark finally ignites things. And what I hear you saying is we're building up more and more and more of that dry tinder, so that when there's a clearing event, it's just going to be catastrophic because we've let so much grow up over time. I also want to comment on one thing you said too, which is, interest rates have been so low for so long, and that's been a huge contributing factor to the malinvestment that you talked about. It's let people get access to cheap money, and of course that's flowed into financial assets, which are owned by the already rich, and it creates a big wealth gap, all kinds of societal issues around that. But one of the things that it does is, it destroys the incentive to save, and it really unfairly punishes very important socioeconomic groups, right? It punishes the old because they can't retire on a fixed income the way they used to. And it punishes the young because they can't form capital nearly as well because they don't get any return on their savings. And it's also driving, the price, it's driving price inflation, right? As the price of everything goes up. So, more and more people have fewer and fewer options to be able to kind of make it in the world, except going way out recklessly far on the risk curve, buying some of these crazy, crypto tokens or whatever on the hope that it might be one of the ones that goes up 3,000%. And then maybe I might have a down payment for a house at this point. It's not just a malincentive, or sorry, a malinvestment that it creates here, but it creates a malincentive on behalf of people to do things that in a rational world they would never do. So David, where I want to go with this is clearly risk is being mispriced across the financial spectrum right now, and you've done a really good job of explaining that. A couple quick charts I just want to throw up here. One, there's the Buffett Indicator, right, which is just sort of a national sort of PE ratio. It's at all-time highs. We've talked about it on a number of the past videos here. I also want to put up a chart of margin debt, and I'm going to follow that by margin debt relative to GDP. They're both at all-time highs, right? And that's a sign that, look, people are taking out debt to speculate with more than they ever have before in the past. That's another sign of reckless speculation. And then last is a chart here of we're at record market cap of companies that are trading at negative earnings. Right. So basically, all of these crazy things going on. So the question I have for you is, because risk is so mispriced, if history is any, going to have any bearing on the future, risk will have to be priced more rationally going forward. What are the canaries in the coal mine that you think could be some of the earliest indicators that some sort of correction is at hand? Where are you expecting to see cracks first?
Well, first of all, on your point about incentives for speculation, I think the epitome of that is this whole thing going on. Let's call it a cult called YOLO. YOLO. You only live once. Okay, and that's what they're all saying. Look, we have a chance to make 100x or 50x or 10x by jumping into all of these. Wild speculations, and so you only live once and do it. But when you get more and more and more of the population involved in that kind of speculation, you're just digging a hole that will be very problematic down the road. So I think that's the real. That's kind of the real canary in the coal mine, the rise of YOLO. And 2 years ago, all the big Wall Street banks were saying, well, cryptocurrencies, that's a fraud, that's a hoax. We don't want nothing to do with it. And now they're all setting up trading desks, okay, because, they're getting in on the action at the very end. So I think when you look at all that extreme, the NFTs came out of nowhere. There's this one speculator in NFTs in Florida bought an NFT in October for, I think it was it was about $66,000, and sold it a couple months ago at an auction for $6 million. Well, when stuff like that is happening, or we all saw the picture of the deli in New Jersey that trades on the penny stock market at 100 million, and it's got revenues of 13,000 a year. So you ask for the canaries in the coal mine; these are it. But you can't dismiss them as marginalia or the fluff or the excess on the margin. This is just symptomatic of what's going on everywhere. And at some point, I think the music's going to stop. I don't know exactly how. The Fed's going to make a mistake, or the market's going to misinterpret the Fed, or there's going to be, an announcement like one that happened this week. They're going to, to fund the next phase of Sleepy Joe's, human infrastructure investments, are going to raise capital gains taxes to 39% for people that have capital gains above $1 million. All of a sudden, the market did a parachute straight down. This may be a 1 day or 1 week wonder, but the point is that those are the kind of catalysts that we never see coming. But they're going to be a catalyst. I mean, these bubbles are too extreme. They're too fragile. They're too extended to not expect that some, black swan, whatever you want to call it, is going to appear one day. And when the unraveling starts, the central banks are not going to be capable of arresting it. The idea that the central banks are omnipotent, that the central banks can backstop any level of speculative excess, I think is really wrong. The central banks have, maneuvered into this because they've lost track of what their job is and what they're doing, but they have no idea of how to keep this whole, this whole game going.
We hope you've been enjoying this conversation with former U.S. Congressman David Stockman. The interview continues in part 2, where David really digs into the Federal Reserve, as well as shares how he thinks that today's investors should be preparing for the type of market reckoning that he sees coming. To watch part 2, just click on the link provided in the description of this video below, or simply go to youtube.com/Wealthion. And to make sure you're notified whenever we post a new video on this channel, click the subscribe button below and that little bell icon right next to it. And in return, if you'd like a free, no strings attached portfolio review with a financial advisor who appreciates the market risks that David has been warning about here, simply go to wealthion.com and we'll set one up for you. Okay, I'll see you over in part 2 of our video interview with David Stockman.